why then do an APO versus doing a rights issue? Is what's the aversion to doing it? Because personally, I haven't seen a good rights issue. I know Key has done maybe a rights issue, I think in 2020. I don't really remember the parameters or what happened then, but since I've been investing in 2019, I have not seen a good rights issue, and there have been way more APOs than rights issues. So I wanted to know, is there some reason for that? Is there an aversion to doing it? Is it way more complex?
Well,
What is it?
well, what happened? What happened? What happened? Thaon, is that first of all, we're working with a relatively short time frame, right? So it's just so happened that that time period was biased by a certain investing cycle. Most of what has happened since 2019 is biased by the pandemic and its knock-on effects in the last 2 years thereafter, right? So what do I mean by that? The same reason why you haven't seen more rights issues is the same reason you haven't seen more IPOs. Not APOs, IPOs. Why you haven't seen more deals come to the fore when they were promised to. Look at how many transactions were postponed.
Mm.
So it goes back to what is happening at a macro level. Because for
No, but
context,
even before, this bull market and so on,
mhm,
before I didn't hear about APOs before JMMBs, and I heard JMMBs is the first one that we've had on our market, right?
mhm.
It may not be, you know, um, very specific to our market. I've only heard APOs in our market. I'm pretty sure things like that happen in other markets and so
Yeah, I
on.
think there was one in
Um,
Trinidad too,
mm,
some years ago. But what I was saying in
yeah.
Atean, even with proven,
Mm-hmm.
in 2011, 2012, 2013, 2014, we did a lot of rights issues. A lot of the
Agree.
whole or early deals
Mm-hmm.
were financed were actually through rights issues. So that's why I was saying to you, we're working with a very short time frame because that time frame would have been biased by the pandemic. Because remember, the pandemic and its knock-on effects would have dominated the last 4 years. Because even now, we're not dealing with the pandemic directly, but we're dealing with a lot of the tail effects of what the
Mm-hmm. So
pandemic
it's
did.
harder to like raise money and so
Right,
on.
right. And you would have seen less transactions. It's the same reason we're seeing smaller trading volumes. It's the same reason we're not seeing the gains that we used to see before. So it's all of those things put together. But to answer your question though, you're asking me about rights issues and why rights issues would be chosen over APOs, etc., or why
Yeah.
one transaction might be chosen over other. Two things. One, it depends on how much money the investor really wants to raise. Because let's stop talking about securities for a little bit, and let's think about it like a party. You want to have a party and you want to make a profit, and you want to sell as many tickets as possible. Now you can do one of two things. You can either have a super ultra experience, where you have a guest list and you only offer it to that guest list. That's like the right issue, right? That's a certain model and approach that you want to use because you want to only have 300 persons at the event, point blank. But if you have a venue that can give you a different experience that doesn't need to be premium, and you can take more of a mass market model and double the size of the number of guests and raise more money, because your objective is to raise more money and not to have a ultra premium experience, then you do an APO where you invite everybody, both persons who supported you before and people who never came. So it's all a matter of how much money you want to raise and how much you're looking at control/dilution. So if you care a lot about dilution, then you're more likely to lean towards rights issues. But if you're really focused on raising as much money as you can raise because of the goals of the company, then you'd go APO.
Mm. So is it that if you want to raise, let's say, a lot of money,
You're going
you
to be less
can't do a
picky. You're
rights
going to
issue?
be less picky. You're going to be less picky because you are focused on the amount of money you want to raise. Rights
No,
issues
I'm not
are
saying no, but it's I understand that it would be easier to. I want to understand why is it so much easier to do an APO in that sense? Because
Because it's an offer to everybody. It's an offer to existing shareholders and persons who have never invested.
You're trying to
Rights
say if
issues.
the
okay,
existing shareholders don't have the money to fund into the company,
It doesn't have to be a case where they don't have the money. They might
or
be
they
at
don't
their
want to spend
allocation
it.
limit. No, they might be at their
mm-hmm,
allocation
Oh,
limit. Some
mm,
pension funds can only take a certain amount of exposure to one asset by investment policy. So it's not always a matter of having the money. Sometimes you cannot digest an asset. You cannot take more. You can probably
mm,
only put up another 2 or 3% in terms of your overall portfolio exposure.
mm. So the
okay,
pension, say your top 10 is made up of a lot of pensions, and they're at 5%, and the limits based on some rule is 6%.
The,
But
the,
then the
the,
amount
the,
of
the
money you'd
rule
have to
the
raise.
rule is critical. The rule, remember the bulk. Remember I told you equity hard to get in. Remember, we need to go back to the original discussion. Equity is hard to get. Who has the most equity? Institutional investors.
Mm.
Institutional
uh,
investors have limits. Now, if most of those institutional investors are at their limits, then you're going to have to bring in who? High net worth individuals who have more latitude, who can take on as much as they want.
Mm.
okay. I wanted to
So
go
you're
back to
dealing with
one of your
different investor
points.
categories.
Yeah, I wanted to go back to that same point though. You're saying if you want to open up the offer to others in order
Like
to
having the
broaden your
party where you're
market
bringing
reach,
everybody.
yeah, couldn't you? And I know it's something we didn't talk about, but couldn't you just make it the rights renounceable? That way, it still is quote unquote for everybody, where you're just giving shareholders um that right, you know, with a right of first refusal or so on. So I, all right, my
So you're saying the
understanding for
shareholders who can put up money because they're not,
yes,
they have the capacity to, because they aren't
mm-hmm,
near to their limit, they could put up their money, and then say there's an extra 10% of funds has to be raised. You're saying you could renounce those rights. So say there was a shareholder who had a limit,
yeah,
would want to participate, but they can't. You're saying they could then renounce their rights to someone else, and then a rights
yeah,
issue could still be done, is what you're saying.
yeah. They could opt to be diluted, whether you want to, actually purchase the shares with the rights that you have or not, or just give up the rights themselves to somebody else.
Well,
And I was seeing that. All right, so renounceable versus non-renounceable rights, and just let me get this clear, just for the people that are listening. Renounceable is what we're talking about, where I've seen where it can be. Is it that it can be traded on a stock market, where it allows shareholders to just sell their rights to other investors if they choose. Like if you're doing a renounceable rights issue, and I'm a shareholder, but I choose not to exercise them, I can just sell my rights to like Preston or somebody else. Whereas non-renounceable, you can't share them. So shareholders, either you have to exercise your rights, and if not, they expire. But my understanding from when they expire is if you have somebody that's underwriting it, meaning like an investment bank comes in, they are agreed to buy like, any shares that are not taken up by the existing shareholders. Then that's the only way I guess you do a non-renounceable. In order to just feel safe, because if a lot of shareholders don't take up their rights and let them expire, you'd need somebody to actually back that. So I get that, but is it? I just want to. I'm still struggling to understand why a lot of companies don't do rights issues and why they opt more for APOs. Like I'm looking on it from the both sides. So from the institution side and the retail investor side, and I see a lot more negatives for an APO for the retail investor side. But I'm trying to see what the negatives are for a rights issue on the investor, like the investment banking side, the company side. Because if it were me running a company, I mean, I'm also looking towards my shareholders. And even in a soft market, I wouldn't want to add another factor. If I choose an APO and I know that, there might be a short term hit to the stock price, and I can just as easily do a rights issue, I'm still trying to see why you would still choose to do an APO. Like, is it
Remember what I said to you,
easier?
Thaon.
Go
When
ahead, bro.
you do an APO, your book value goes up. Book value and market value is two different things. So when
Maybe I
those
never
new
understood
shares,
that. Can you explain that? Yeah.
the book value is the equity. The share capital has increased. So your wealth has
Okay.
actually increased from a book value standpoint. So if your market value has dropped, but your book value has gone up, in theory, that's actually a buying opportunity because your shares are now at a greater discount than really in relation to their fundamental value because your price to book is now less.
And in a rights issue, your book value wouldn't go up.
Your book value would
No,
go
it's
up.
still
I'm
would.
just telling you, no man. So you raise a concern about the share price and the shareholders, and you don't want to affect their share price. The man them book value gone up, including yours.
But
And the
if both
question is,
happen,
no,
like,
Thaon, no,
mm-hmm.
no. I ask you a question. You need to think
Okay, shoot
about
the
why
question.
you bought to begin with. That's the key, you know. The reason you buy
No, I know
into a
you're
company,
looking on it from the investor, but I still am looking on it from in the investment banker, the company side. Why choose something that will, as an investor, yeah, you know your goals, you know your and so on, but you don't know that a company may do an APO. You don't know that a company may do a rights issue. Right? You don't know that. You bought into the vision, maybe at IPO, or you bought into it maybe just off the market because you do your analysis, you like the company, you buy into it, fine. Right? We can't time APOs as retail investors. We can't time rights issues really. I don't think you can time them. You never really know when one may just pop up, unless the company announces it. So that can derail your goal. Now, if I were in the company and I had both choices, I don't see why you choose one over the other. I'm still struggling to see why. Even
because
even if it's not that you're raising an exorbitant amount of capital.
no,
Suppose if
because
I've seen, okay, go ahead. Yeah.
because first of all, you cannot.
Mm-hmm.
So there's a lot happening at the same time.
Mm-hmm.
So let's deal with them one by one. So number one,
Okay.
regardless of what you raise, whether a rights issue or APO, when you're raising equity, your book value goes up.
Okay.
Remember that first and foremost. And that has a
Mm-hmm.
wealth effect. Your net worth is now higher because you now have a larger equity base.
Okay.
If the price drops, it means that the price has dropped, but your book value is now higher, so your price to book is less. Now, what the investor would need to do is to think, okay, if my price to book is less, am I looking to capitalize on this as a buying opportunity? Or do I not care because of the reason I bought to begin with? That's the first part, you know. That's where you need to start. Why did I buy this to begin with? Was I just trying to flip this and the extra shares is going to mess up the flip? Or am I looking at something that I can buy because I have a smaller price to book? I'm getting it at a larger discount just from the standpoint of the transaction. So that's the
I,
first thing. The second thing
mm,
is nobody
okay.
in the Jamaican market can assess the true value of APOs until you're looking at it in a bull market and a bear market. That hasn't happened as yet. Right now, we're only looking at one side of the coin because not enough time has passed for us to assess both. It's literally impossible. We're literally only talking about APOs in a bear market. And even if you don't call it a bear market in the technical definition of the market falling by 20% or more, the market is still soft. There are many equity transactions that were postponed. Average traded volumes have fallen. Upside is less. There are many deals that didn't come to market. 2023 only had one IPO. So we need to look at it from a multi-pronged perspective and not just looking at it as, is this bad? Not enough time has passed. 4 years in the market is not a long time. That's how many quarters? 4 times 4, 16 quarters. That's not a long time. A company, you building a company from scratch and you're talking to an entrepreneur and you tell them about running a company for 4 years. That's not a long time. That's what you're doing when you're an equity investor, you know, when you're a shareholder, you know, believe it or not. Investing in a company for 4 years is not a long time, Thaon. So we have to wait until APOs happen in a bull market before we can objectively say what is heads and what is tails. Right now, we're just talking about one side of the coin. So nobody knows. You don't know that. None of us know. We can compare IPOs in both because IPOs have happened in both, but APOs have not yet happened in both. So what are we really arguing? It's not apples to apples. It's not. Not enough time has passed. The first one was literally weeks before the pandemic. What are we really comparing? Other values were dropping too. Other volumes were dropping too. Other upside has been reduced. Other transactions were cancelled. IPOs that were supposed to come. Government assets that are huge, that have guaranteed money to back in. We're talking about pension funds. They didn't come. So what are we really comparing? It's not a balanced discussion. It is narrative, Thaon. That's what I keep telling you.
It's a lot of the things we're talking about. You're right. Like it is some
It's
of the things
narrative.
you're saying are right.
And the
I
people
would
who have
say
pushed this
it's
narrative have ulterior motives, Thaon. And that may I try to show you upon the call. It's not objective. They want to find an excuse why their bets never play out. So they're blaming it on the APO. That's why them start drive the narrative. It's because them bets on Twitter never play out. So them need something for blame. It's a boogeyman. That's a part of it. It has nothing to do with the value of the investment itself. These are people making excuses, Thaon. It's not, I don't know. I'm telling you what's happening.
No,
I've been in the market a long time, Thaon.
I'm not saying all right. So for all of what you're saying, there's truths. There's definitely probably truths behind a lot of it, but fundamentally speaking, knowing that you're inciting selling pressure in an APO
You're not
versus
inciting selling pressure. You are going through selling pressure because of what's going on in the market. Because selling pressure is happening on assets for different reasons because of what's happening at the macro level. It's not specifically because of the. It's not happening because of the trend. No, Thaon, hold on a second.
I would like us to
Thaon,
forget
just hold on
bull
a
market
second.
and bear market.
No, you cannot forget it because markets are about the cycles that they're in. You're not listening.
I'm
Things
listening.
don't trade the same way in the cycle.
Julian, trust me, I'm
not
listening.
Creating sell pressure on it. You're not. You're not.
Preston, do you believe that? Because Preston's there smiling. You are giving anybody the opportunity in an APO to buy in at a discounted price to market, knowing that, well, if the APO price, the subscription price is lower, and with a rights issue, you can create demand by allowing shareholders, right, the right, giving them the right to buy at this discounted price, right? I don't see how, if it's in a bear market or a bull market or so on, you can create demand in a rights issue. And there are rights issues that can go bad, don't get me wrong. But generally speaking,
we have a bigger problem.
How so?
Because I've explained the thing to you and you're not listening. I've been very thorough in my explanation. You literally don't know how APOs are going to perform in a bull market. You don't.
And that's why I said we're taking out bull and bear markets right now.
You can't. Markets are about supply and demand, and you're literally speaking on something you're only seeing from one perspective. You can't. And the fact is, I gave you the example with hosting an event for a reason. The risk of having an event with just a guest list and having an event that you invite everybody is two different things. The equity raises are not the same. You're literally taking more risk by only offering it to people who only invest in the company already. It's more risk. The risk of failure is higher.
The investment, the company doesn't want, I guess, do an equity raise and then it fails. Say
yes, because
they want to raise $1 billion and they only raise 100 million. It looks away, and then that kind of can turn a negative sentiment.
The more important question is, why am I limiting my audience if I need the money? Why? So, okay, I can get 300 million only from my existing shareholders. But if I can get an additional 100 million by inviting persons who have never gotten it before, And let's take it the step further. All right, fine. We'll make it renounceable and open it up some more. You're still not going to get the same level of money than if you opened it up to everybody. Because the transaction is about how can I increase the book value of the business, number one. And two, how can I deploy the money in this project that I say I want to invest in. Remember, equity is hard to get. If equity is hard to get, why am I limiting my audience? That's why I started the conversation the way I did,
Mm-hmm.
You guys cannot be affected by narrative. It is narrative. Everything I've told you are things that are verifiable by fact. Even if you end this call and go talk to other people and research what I'm telling you, you can find the evidence. These people are creating narrative so that them can defend them quote unquote online legitimacy. I'm not doing that. All this information is independent of me. If I disappear tomorrow, a lot of what I've shared with you can be researched and found. I'm not defending no Twitter, nothing. If you widen the audience, you can raise more money. Equity is scarce to get. It's more risk if I only limit it to these guys. Even if they have the right to pass it off to other people, it's still not the same as saying, everybody, look at my company. It's not the same risk. Especially if I need the money and knowing that equity is hard to get. When you guys start your businesses, or you might have your business already, when you start raising money from shareholders, you're going to understand some of what I'm saying more intuitively. It's not
I
as
guess
intuitive,
I
no.
think this episode will age well. So guys who are watching in the future, 5 years down the line,
Remember
let
when the
us
bull
look
market come back and when
let us look at the
Thaon did
APO
a
prices.
Thaon did a defending bridge in them and I said, Julian, yeah, fight out the thing. Bro,
No,
just
man.
compare apples for apples.
I'm not bringing Twitter or any of this into this. I'm
You see how
just
the man smile
literally
bright?
looking at it. No, I'm literally looking at it.
I
I
feel
think
like
I'm trying to look at it.
I think
I
the
don't
thing
know.
is we've been looking at it on a lot on the APO side, but could you talk about, for example, did we go into which companies, for example, a rights issue might be a better funding mechanism for versus a APO? And what could we get into maybe the pros of a rights issue?
Mm-hmm. All right. So let me just bring it back into perspective. Remember, when you're doing a rights issue, you really are focused on protecting your stake above other factors. So I'm willing to forego my overall ticket size, or I'm willing to make my raise suffer in terms of how much money I can raise because I'm more focused on the stake. Or maybe the amount of money I'm raising can be raised from the people I already have. So again, I'll use a party example. If my objectives can be met by doing an exclusive event, even though it is higher risk, in terms of those persons telling me no, I'm not coming through, if I know I can get that from 50 people, then do it. But if the priority is not the stake and the priority is to maximize how much equity I can get, given that equity is scarce, then why am I going to limit it to a given audience if I don't need to? Because remember, remember, two things. Right after the transaction, the book value per share is higher of the business because the share capital is higher. And remember, that doesn't include the value that's created by them deploying the money, them paying down the debt, them acquiring whatever equipment them say them going to acquire. All of that change the balance sheet, The book value is going up significantly, And depending on what they invest in, the earnings should go up as well. Right? So a lot of what we're saying has actual real implications, but it's just which timeline you're working with. So if you just wanted to trade it, which is fine, if it was just a trade, it's going to screw up your trade. It's going to screw up your trade. I can see that. But what I've been challenging you guys on is, are we going to make the entire legitimacy of the transaction about the trade? That's taking it a bit too far. You just have to put the things in the relevant buckets. So again, if the reason I bought was because financially I was just looking to talk to a sister and I met at a party, I don't know much about her, but I just want to take a risk. May I drink some juice and I feel nice and I just feel like step to her. Fine. If things don't work out, it don't work out. But if it's a case where I have a more long-term bet, I know this person for the last 7 years. She has done a lot for me. I really appreciate her. She gets on top of my nerves, but she has done a lot for me. She fit well with my family and my friends. It's a different thing. It's a different animal we're working with. So Thaon, the question I'm asking now is not so much of the validity of an APO over a rights issue, but more so, what type of play am I making? What's the bet am I taking on this business? Is it a one-night stand bet or is it a marriage bet? Or is it neither? That's really what puts the transaction into context. Because the entrepreneur is trying to maximize this scarce type of capital that they're trying to get. Equity hard to get. Why am I limiting my audience? Why am I taking more risk when I don't need to? If I'm not taking the risk and I'm just focused on the stake and I know I'm willing to give up the overall size of the raise, and not only that, if I know I can get at least 100 million from the people I already have, then screw the APO. But I just don't want you guys look at it the wrong way because of the narrative. There's a very unhealthy narrative out there, and a lot of it is it's not an honest discussion. It's not, because it's not balanced. You need to look at it from heads and tails, and also look at the angle of the entrepreneur, the investor, and the value that is actually being created, if any. Which was my point of contention with 138. That's why I'm look out against it, man. I say, yo, the price doesn't carry the risk. That's all I was saying, you know. So even that now, Thaon, I never supported that. I put do not recommend. So I don't want it to be a case where, yo, this industry brother are different APO, I'm try making bread and eat food. No. I just want you to not be boxed in by a narrative that's already established, because it's not an honest discussion. If you're going to turn down an APO, at least you know it's for an honest reason. The transaction don't make sense because something wrong with the transaction. Not because it's an APO, but because of this item here. I'm investing in an asset that I can't see.
Are there any APOs, for example, for the ones I don't think it's been that many, maybe like 5 or 6? Are there any APOs that, for example, you thought were some of the better structured deals, or do you think that maybe we haven't
You mean
seen an APO
compared to
that's
138?
No, I'm just saying, like in general, was there an APO that you're like, okay, that was a pretty well structured deal? You thought that the price that they were giving you was a good value,
I
or
think Barito.
the same Barito?
Especially the first one. The
Mm,
first one. The second one wasn't so bad, but the first one, comparatively. And
Barito.
again, everything is context, you know. Everything is context. So again, you're looking at deals on a case by case basis, but everything is relative. So like, could they have made more money if that deal happened 3 years prior? Probably. So that's what I mean by it's relative, which is why I was saying to Thaon earlier, okay, we're looking at the pros and the cons of the transaction, and we're seeing where, for many investors, the cons have outweighed the pros in the immediate term. But again, maybe it is biased by what we're going through on a market level. That's all I'm saying. And none of us know for sure. That's all I'm saying, including me. But let's have that discussion when the time comes. So if it's a case where, okay, the last 3 APOs came out in a bull market and the price dropped and it does never recover because of the APO, that's a different discussion. But that don't happen yet. It literally don't happen yet. So let's cuss about it after it happened. That's all I'm gonna say. That's all I'm
one
gonna
of the
say.
things I would say though, I feel like Barita in a way is a bad example because, not that I don't agree with you, but Barita, if you look at the ownership structure, Barita is cornerstone, or their crown jewel essentially, and they use the share price to their advantage. So I remember, for example, there was a point where they secured they got a secured loan and it was backed by the shares of Barita. So, for example, if the share price were to fall significantly, then they could technically get like, some issues with whoever they're lending them the money. So, for example, that then puts a interest for them to say, okay, if the shares are falling, let's try to maybe buy more shares or something like that. So, but then I guess the other thing is that with a lot of the APOs, for example, there are companies that, for example, they book profit based on the market value of the security. Then there's some companies where they don't book profit based on the market value of the security. So if the book value, or say the market value, was to be very low in relation to the book value, like it was trading at a discount, it wouldn't necessarily matter to them. But then there's a company where it's the market value. So if the share price drops, they're going to feel it too. So if, for example, say I was the controller of a company, they do the APO, and I'm booking that company based on market value, I'm going to defend that share price because I have to. But if I'm the company, I control it, or I have the largest stake, I don't care about the market value because I don't book it. I do the APO, it doesn't really matter to me. So maybe I wouldn't just buy shares on the market. So it's different. So Barita, I see why, for example, that one wouldn't have maybe suffered as much in the share price, I guess.
Well, the truth is, Preston, I wasn't even thinking about it just from the standpoint of the share price falling immediately after. I was just going back to the same 138 checklist. So
on
in
the
terms
risk,
of right, does the price, because that deal, it wasn't at a discount. Meaning,
Barita, you're saying?
yeah, in terms of no. So let me reframe that properly. In terms of the margin of safety wasn't that big. But guess what? It was more an upside bet of what Barita 2.0 would have looked like. And that has transpired, meaning that I have seen where the company has created new products, have hired new staff, have created new services, expanded its branch network, change the marketing apparatus, all of that stuff. So that's what I meant by the deal being structured. So in other words, Barita 2.0 was promised, and Barita 2.0 actually materialized. And the actual asset base and book value of the business post the transaction is way bigger than before. So that when you say it to me that way, that's how I'm thinking about it, because that's what the transaction was for. So yes, you do have the risk of entities benefiting from moving their share price and trying to manage that. That is a very real risk. But I don't think that was the underpinning drive or motivation for the transaction itself. Because of the things I just highlighted, they actually followed through on much of what they said they wanted to do. So, all right, let's talk about some other deals, right? For example, Dermon. I'm very disappointed in Dermon because I think they overextended themselves in terms of the use of proceeds. So they not only grew the business organically, Thaon, they did a lot of acquisitions, and the assets they bought were big relative to the other projects that they were doing. So what you find is that in the last set of financials, there was a bank overdraft. The bank overdraft was more than 500 million, I'm not sure the exact amount.
I'll pull it up. The most recent, the March quarter?
Yeah,
or the one right before that. Because sometimes I go through financials as they come out, and I just go through but the bank overdraft stood out to me.
This one? Or the audited?
Oh no, go to
most recent one?
It's in the cash flow, the bottom of the cash flow statement.
It's in the thing there
didn't
too,
show up.
It's in the thing there as
I
well.
was searching it.
It's on the balance sheet as well.
It's over 500 million.
Yeah, when you have a bank overdraft over 500 million, what it means is that you have a funding gap that you need to fill, because bank overdrafts tend to have very high
interest
interest
rates.
charges. And you tend to not take them unless you absolutely need them. And look at how much it changed year over year, from 26 mil
Yeah,
to
wow.
almost 503.
Mhm.
It means you're running out of money. But how is it that you're
And they
running out
already
of
raised
money
so
when you just
much.
raise billions? Yeah.
Yeah.
Exactly.
So they obviously
Oh.
overextended themselves.
Mm.
So that's the
I remember
opposite of what I was talking about, read the Barita thing.
we had done an episode. You see my screen. We had done an episode where we spoke about the NCB APO, and one of the things I was doing, I looked at some of the APOs, and I was comparing the size of the company in terms of the number of shares pre-APO, and then how many shares they ended up issuing, and relate that to the amount of shares that they had before. And if you look at, for example, DTL, Derman here, it was actually a very large raise in relation to the size of the company versus something like NCB, where it was a much smaller raise in relation to the size of the company. So they were almost like creating a new company. They were taking on a lot of money. And I guess the thing is, I guess that ties into the same point you made about supply and demand. If you increase the supply of the shares, the point is you're supposed to do something with that money to
Correct.
then increase the demand of the shares. But if at the end of the day you don't, and you do something that even it decreases the demand of the shares, and you increase the supply, it's not gonna be very well for
It's literally a
the
worst
value
case
of the
scenario.
business.
It's a worst case scenario. Because
You
you
know
get in.
who talks about it a lot? Chris Berry.
Yo, detail. I wonder
No,
why.
but Thaon, so like that one, yes, it's true, but remember that Derriman used to be Mayberry's client, you know.
Yeah.
And
So
as Julian has been saying a lot tonight, there are other factors sometimes that
yeah,
you're
that's
not.
all I can say. They used to be
Yeah.
Mayberry's client, and then they switched to Barito. And I think a lot of the complaints were happening just from that switch.
Yeah.
So even before the transaction happened, you know, there were a lot of concerns because, you know, they switch advisors, they switch their financial advisors.
Yeah.
But hopefully in part 2, we can really look at what we didn't cover, and we can have like a little bit more structure around it. But I really just wanted to cover it from a philosophical perspective to say, all right, cool. Where's the market? Where are we? What are we missing? What are we overlooking? Or what are we placing too much emphasis on, you know? Because the reason I feel so strongly about it, I feel like because the conversation is not always an honest conversation, persons who are not in the industry are being robbed. They're being robbed because there's a lack of balance to the perspective. So yes, every side has concerns that are valid, and what you said is valid as it relates to the fall in the price right after the transaction. But again, we have to look at all the angles. What type of cycle are we in? What's the money being used for? Is the increase in the book value meaningful to me because I'm taking more of a marriage bet than a one night stand bet, right? And why did I buy in the first place? All of those things have to be considered. The pricing, again, does the price make sense? Because again, if the pricing don't make sense, then the fact that the share price fell is going to mean something different than if the price made sense and the share price fell. That's two different things. So in both cases, the share price fell. But in one case, the pricing made sense, and in the other case, the pricing didn't. Not the same animal. And it also informs why I bought to begin with. It's all of it combined. But you're not being offered that perspective. You're being robbed because you're talking about the funding methodology in a vacuum, which is not fair. Nothing should be in a vacuum. Even rights issues, they shouldn't be discussed in a vacuum either. So that is why I push back so hard against it, because you guys are being robbed. That's just how I feel about it. And it's a narrative thing, and I don't like that because it's harmful. Because you could be losing out on a deal that might have been in line with your goals.
Yeah, I will say that I also, it's not that I'm, bashing APOs because at the same time, I've never seen a good rights issue either. So yeah, like
Not enough time passed there on. That's it.
As in,
since I've been investing,
Not enough
let me
time
say that,
passed.
Preston.
okay,
Since
saying
I've been
burrito.
investing, yeah, that was before I was investing. That was what 2017, 18.
Bro, yeah, sure.
The burrito had two rights issues.
No, man. The rights issue happened since I invest money. Just don't remember. Because remember, the APOs and the rights issues were happening close to each other. You know? It wasn't that long.
The one I know since I started was Fast Rich. Yeah, sadly, we can't say I create. So
I guess. Oh, this is September 2019. Barita completed it.
Preston.
I would have just started.
Preston, you need to go church Sunday, bro.
Wait, what did Preston say?
Him say,
anyways, moving right along.
I
guess everybody else heard.
Yeah, rough. Wait, there are people live?
No. It's not live. It's not live.
Yo.
No. Yeah, I create rights issue.
I wonder how nobody now cuss me when I say, nah, it's not live. I'm not getting nobody. It's not live.
Yeah, it's not live. I guess when it releases, you'll see.
Of course. A bag of people, you know the usual. It's Dr. Doom. You're going to get your Dr. Doom response. People are going to be like, yo, the man, come with this industry people. And I'm talking to you as if you were my client. That's how I talk. Every time I come on this program, I talk to you as if you're my client. Not that I'm telling you what action to take, I'm merely telling you what you might be overlooking. That's my job, to literally show you where blind spots could be and discuss those blind spots. And then you're making a decision. At least I know you're making a complete decision, a decision on complete information.
I always like hearing different perspectives.
That's all 100%. That's all it is.
Yeah.
And sometimes you have to stop them from making decisions that's harmful to them that they might not even know is harmful to them. And you go through that every day as doctors. You're like, bro, I tell you the dose. I tell you say it's 2 tablets. What do you mean if you take 1? Because your granny say if you take 2, you're going to drop down. Bro, I'm the doctor. I told you 2 doses because that's what the data was saying, isn't it?
Yeah. It's funny that you mentioned that literally a patient had to cuss because of something like that. Literally like 2 days ago. What day is today? 2 days ago. 2 days ago. Yeah. So, yeah, crazy. But you're right. And I like hearing the different, as I said, I love hearing the different perspectives. Julian, I think you brought just a wealth of knowledge, right? And the way you structure the conversation, I mean, based on our previous episodes, we had slides. I don't think we really missed them.
You don't get 100%. No, I missed the slides.
Yeah, you're a nerd.
In part 2. In part two. Bring the slides.
Yeah, guys, let us know in the comments below if you want to hear part 2 with Dr. Doom.
Yeah, or if you have one,
drop a like.
But for real though, honestly, you say I bring a wealth of knowledge. All of us it's really the value of the conversation,
Yeah.
Even the back and forth, and when we're challenging each other, that is really the benefit. That's really the benefit. So it's not even about me imparting knowledge. It's really about the conversation. So I have to thank you as well because it's a good platform. You have the beauty of Limitless is that there are so many persons who only listen to Limitless. They like Limitless or not. So you might not look on it that way, but there are people who are just like, yo, I'm learning everything about investing from Limitless because I'm not going to any other source. So don't underestimate what you have. So big up for the platform. Thanks for having me. It's always good. Don't feel no way when I push back, and because I don't feel no way when you push back because there's value. There's value in that. It's positive tension.
Yeah.
It's positive tension. It's necessary.
100%.
Which is what always grates my nerves online. You don't get an opportunity to have positive tension. Tension is negative. That's what I don't like. But this call is positive tension, and that's what you need. That's what protect investors, positive tension.
Truly. All
Yeah,
right.
man.
Well, thank you so much, Julian, for coming on Limitless again. All right. Guys, if you love this episode, just drop a like, right? And if you want to hear more, if you want part 2, comment so Julian, drag Julian in the comments. Be like, Dr. Doom, we need part 2.
We're doing yo.
All right. Well, thank you again, Julian. Limitless out.
Yeah, man, thanks for
Peace.
having me, man. Bless.